Welcome to Strategic Alternatives, the RBC Capital Markets podcast. I'm your host today, Vito Sperduto, Head of RBC Capital Markets US, and in today's episode, we're taking a closer look at the global equities landscape, what's driving markets, how client demand is evolving, and where new opportunities are emerging. To do that, I'm joined by James Masserio, who heads up our global equities franchise. James, welcome to the podcast.
Thanks, Vito. Appreciate being here.
So why don't we start off by just kind of setting the stage? And I think it's important, just given a lot of the volatility we have in the marketplace, that our audience understands where we are precisely. Today is October 16th, 2025, and we're recording in the middle of another test for policymakers and markets alike. The U.S. government is on day 16 of a shutdown, and according to Polymarket and a lot of prediction markets, there's a 77% expectation that this is going to go 30 days or longer, which is interesting to watch. And look, the reason that matters is it means that the Federal Reserve is going to do the next rate cut decision at the end of this month without some key economic data that they're used to seeing. They're not going to have jobs, inflation, and consumer spending reports, given that those are all going to be delayed due to the shutdown. Our colleague Blake Gwynn, RBC's head of U.S. rate strategy, points out that the real impact isn't on Treasury issuance or default risk. Those are continuing uninterrupted, but rather this data vacuum is something that policymakers have to confront. And so without official new data, the view is that the Fed will likely continue cutting rates and move forward in that regard. And then importantly, one thing to keep in mind with this shutdown, this isn't a debt limit crisis like some prior shutdowns. And so that's likely to cause this to go longer. When we look at the equity markets, our head of U.S. equity market strategy, Lori Calvasina, sees the equity market entering a critical inflection point. In her latest report, she points out that earnings sentiment is fading, and particularly beyond the largest market cap names, we're seeing that sentiment really play out. And then we're also seeing that the rate of upward EPS estimate revisions has slipped. Valuations remain stretched. And critically, institutional investors are beginning to look at this as a potential period of digestion, as she's calling it. James, with all that context, let's bring it back to the platform itself. You joined RBC earlier this year after leading markets and equities in the Americas at another firm. Given your background, how are you approaching your role here, and what priorities are you driving across our global equities business?
Yeah, thanks, Vito. As you mentioned, prior to joining RBC, I was running global markets division in the Americas for a European bank. And before that, started in the business as an equity derivatives trader. So I bring a trader's mindset, if you will, to running the business. And I see an incredible opportunity for RBC in the equity asset class. RBC is a massive financial institution. We're now over a $200 billion market cap company. And the equity division is still, I would say, relatively small compared to the size of the firm overall. And so I see a real opportunity, not just over the next year or two, but really over the next 5 to 10 years to grow the business, both geographically and across products. I think there's very few firms that are positioned like we are to make a significant move from a growth perspective and a relevance perspective within the asset class of equities, specifically over the next several years.
Let's pivot a little bit in terms of what clients are focused on right now. I mean, as you think about the current environment, are clients already positioning for a scenario where macro visibility is low? I mean, are they hedging tail risk, shortening durations, reducing directional exposure? I mean, what are you seeing that they're focused on right now?
Yeah, the equity market specifically have been very constructive for a long time. Strong earnings, favorable monetary policy environment, and all that creates a very good backdrop in equities. That being said, we're seeing equity valuations at historical highs. And so it's a real challenge for the investment community to make that decision between how invested are they and how much are they participating in the continued performance of the equity asset class, while also being disciplined in the context of where things are priced historically. So we're seeing clients start to use derivatives more and more in order to express that. So instead of just putting cash on the table, buying a stock position outright, you could put a defined amount of risk on the table via buying a call. and you have a certain amount of premium. Or you could buy that stock position and you can buy a put to protect on the downside. So we're starting to see the need to become more sophisticated with how you express the view in the equity asset class, given where we are in the cycle. So it's quite likely we can see much more upside, over the next 6 to 12 months. But at some point, valuations are going to normalize. And if valuations normalize, there's a lot of room to drop on the downside. And you never know what that catalyst is. We could probably come up with 3, 4, or 5 things right now that people are considering, but it's generally the catalyst that you're not considering, which is the one that really takes you down and brings us back to a more normal valuation. So it's a tricky environment. People are doing well, but it's difficult on a relative performance to keep up with the generic market acceleration. And so that's really the challenge. Clients having to become a little bit more sophisticated about how they cover their bases across those different future scenarios.
Yeah, it's interesting. I think the themes you just echoed in terms of being resilient, being prepared, regardless of what scenario comes up. There's no other time where they've been more important. So that's key. But maybe if we step back and look at some of the data, where's the demand most concentrated in your business today? And which product categories really stand out as growing right now? I mean, do you look, for example, at the current growth in derivatives, as you've mentioned, and in financing? Is it defensive, versus directional? I mean, how do you think about it?
Yeah, and really going back to the financial crisis as a major pivot in the industry, we're seeing client demand come out with much more growth in the category of derivatives and equity finance. And so if you look at consultant data over the last 10 years or so, you actually see the cash equity wallet on the street drop 20% over the last 10 years, while the derivatives wallet has grown 65% and the equity finance wallet has grown 40%. And that just speaks to purely the demand and the needs from our clients. Clients are trading more and more derivative solutions in a variety of different products, and they have more and more demand for equity finance. So as the clients become more institutionalized and grow, and you kind of have a bifurcation of the big keep getting bigger, there's more and more need for solutions, sophisticated solutions, whether they're expressed kind of unilaterally within the institution or as an overlay across a more complex buy side client structure or more financing needs, geographies, in equities, or cross asset classes. That's really the kind of mega trend, is the increase of demand across those two main categories.
And James, I mean, if we dig a little deeper in terms of derivatives and financing and how clients are using these tools differently, what's changed in how they manage risk and deploy capital? I mean, you've talked about the growth, but are clients demanding more counterparty diversification, or are they mandating more collateral and transparency? How is this impacting what's going to be a more drawn out, uncertain environment?
As the big get bigger, there's a need for more partnership. So you can't find all of your needs across, let's say, 50 different counterparts, each which are niche. There really is a demand for clients to pair off against institutions like ourselves who can provide solutions across all asset classes, across all regions. It just makes things much easier for the client ultimately to have less touch points and be able to go to institutions where they know they can rely on and they can find what they need in a variety of different places. In terms of some product evolution, I mean, one thing in the derivative space in particular, and this is a multi-asset solution, is the QIS product, the quantitative investment strategies products. And so these are investable indices developed by the sell side banks that can be expressed via several different types of instruments. They could be a swap on that index, there could be options on that index, they can be embedded into structured notes. And like I said, they can be across all asset classes and be devised of really any of the product types within any of those asset classes. It could be futures, it could be stocks, it could be options, it could be a number of different things. And it's really a way in which the banks are able to export their operational infrastructure to our clients. And so they've gained in popularity. Originally, they were most used by pension funds and then started to be adopted by asset managers. And now we're seeing hedge funds use them more and more. So it's a very easy way to get into a trade that could be complex from an operational perspective. There's transparency, they're generally low cost. It's just a very easy way for clients to express a variety of views and also often in a multi-asset perspective. So that's been a big business, a big product that's grown over the last 10 plus years. And I think it shows the level of innovation and sophistication that is being required by our clients and also being delivered by the street. So that's something to pay attention to. It's going to continue to grow. It's a big focus for us here at RBC. We're making a big multi-year investment in the team to support that. And it'll be a bigger part of the, not just the equity business, but the global markets business going forward.
Well, James, now that you're at a Canadian firm, I think the appropriate way to refer to that is skate to where the puck's going, right?
That's right.
Look, when you think about the next several years, which you've mentioned, you've highlighted some efforts we're making to build out portions of our business that are going to be critical to our client base in those years. Where's the equities industry heading, and sort of what areas are clients and institutions most focused on, especially if there's sort of multi-partner models across geographies? I mean, how are we linking that together? Because we're talking about a global business, not just one specific market.
Now, in 2025, we're seeing volumes go up everywhere and performance strong across all things equity asset class related. But I would say from a regional perspective, Europe and Asia definitely of more and more interest to clients. And we're seeing that come through in terms of activity.
And one of the things you talked about is sort of the fact that a lot of the hedge funds are requiring a set of global partners across the various geographies. I mean, as you think about that, how do the smaller players or new entrants play into this? Are they showing up with a greater agility on the technology side because they're not dealing with such a large institution? I mean, I think of us at RBC as kind of a bit of a hybrid. We're a large global player in some senses, but I'd also like to think we're incredibly agile in being able to adapt to what's coming to our client and to our client needs. I mean, how do you look at that?
Using the financial crisis as kind of a major inflection point in the industry where the rule books were significantly rewritten and that creates new strategy for all the participants. And so on the bank side, there's a huge advantage with scale. And on the client side, on the buy side, there's a huge advantage with scale. And so I think that is driving a lot of what we're seeing across a number of different areas. And to compete without scale, you absolutely have to lead with some type of technology innovation. You can't play the same game without scale and have margins. And again, that's whether you're talking about servicing the buy side from a bank's perspective or being an investment vehicle. The fixed cost requirements are so significant that it erodes the profitability from an investor perspective if you don't have that scale. And it's the same thing on the bank side, that the regulatory cost, the operational cost to do this business the way it has to be done in 2025 and going forward is substantial.
James, given the time you've been here, given what you've seen, give me your quick elevator pitch in terms of how you feel we're positioned and why RBC.
The fuel for our business and the fuel to deliver to our clients is ultimately capital. You know, how much RWA and how much balance sheet do we have to deploy via a variety of products to our clients to fulfill their needs. And RBC has that in spades, primarily across solutions and financing businesses. So whether that's, in derivatives, whether that's specifically within equity financing activities, we have the fuel not just to deliver interactions with our clients, but a real partnership. And that's unique. There's not many firms on the street who can really step in and have the capital to be a legitimate partner, not just a counterpart.
I love it. So the keys I always think about: opportunity, partnership. I mean, those are key words when we talk about advising our clients and being there throughout their full life cycle. So excellent stuff. And just as we kind of get through all of this and wrap some of our conversation up, I always think it's important to think about, is there a playbook or some guidance that we offer up to our clients, especially the institutional investor community? I mean, are there themes that you're seeing that they're focused on, ways they should be thinking about this environment? I mean, you've got a long history in this business across various parts of it. How are you guiding them?
It's difficult to make it through any conversation without talking about AI. We've made significant investments in AI over the last 10 years at RBC, and we're really starting now to see the fruits of that investment. And there's no denying that is going to have an incredible impact on everything going forward. And so it's, like I mentioned before, I think the biggest threat to any business that has scale, and you have to use your scale as an advantage and invest disproportionately in the technology such that it goes from a threat to actually being an advantage. And it is the thing that's going to level the playing field for the smaller persons. And I think in the next year or two, you really start to see separation. Again, whether you're talking about the sell side and how they're able to service clients, or on the buy side, how they're able to use that technology to differentiate themselves. Let me give you a specific example, Vito. In our equity research department, we cover roughly 1,700 stocks globally. And, we have a multi-year plan to grow that from 1,700 to 2,500 stocks globally. 5 years ago, the only way to do that is to hire 50% more research analysts. And what we're doing through AI and the agentification within research specifically is deliver the tools to the research analysts such that they can cover more stocks much more efficiently. There's many ways just within our research department that we think we're going to honestly transform the equity research product at RBC directly through AI. And that's happening as we speak. And I think we'll really start to see that through, clear data in the next 12 to 18 months.
Yeah, James, I could not emphasize that more. I often talk about AI, and look, I take a step back and I look at where we're on an 11-year journey in terms of implementing different versions of AI and managing data. And I think about where we were a year ago, where we were 6 months ago, where we were 3 months ago, and the exponential growth we've had, not just in the usage, but in terms of the abilities that we're able to magnify. I also talk about it a lot as not a cost-cutting tool necessarily, but something that helps us amplify capabilities and drive growth and really enhance insight and speed, which obviously is incredibly important for your client base as you think about it, and helping us to architect our growth in a different fashion. Like all of us have had to rethink those growth models we had, those development models from a technology perspective and elsewhere. How does that change now that we have AI agents that are assisting us in getting to that outcome quicker? So it's incredibly exciting. And look, I think, one of the things that I look at as really creating a greater bond with our clients, because everything we're going through as an institution is exactly what our clients are going through on a day-to-day basis. And it's always great to compare notes with. So, James, I've really enjoyed the conversation. Thank you for joining us today. And, I think that's a great point to end. So thank you for the participation and look forward to doing this again in the future.
Thanks, Vito.
Thank you for listening to Strategic Alternatives, the RBC Capital Markets podcast. This episode was recorded on October 16th, 2025. Listen and subscribe to Strategic Alternatives on Apple, Spotify, or wherever you listen to podcasts. If you enjoyed this episode, please leave us a review and share the podcast with others. Thank you.
This content is based on information available at the time it was recorded and is for informational purposes only. It is not an offer to buy or sell or a solicitation, and no recommendations are implied. It is outside the scope of this communication to consider whether it is suitable for you and your financial objectives.